Hello friends, in this video we are going to discuss the receipts of the state governments. You would recall that in my last video I had discussed the receipts of the union government. So in this video we are going to discuss the receipts of the state governments. Now, before we get into this topic, or before we get into the discussion of the sources of revenue for the state government, we should know some more concepts. So, first, we should discuss the concept of vertical fiscal imbalance. Now, what is this vertical imbalance? Now, if you look at the Constitution of India, then in this Constitution, we have the union list, we have the state list, and we have the concurrent list. Now, in this union list, all the powers of the union government are described. That means what are the responsibilities of the union government. Similarly, what all taxes can be collected by the union government. So both revenue raising capacity of the union government and expenditure obligation of the union governments are enlisted in the union list. Similarly, when you look at the state list, in the state list, the revenue raising capacity of the states as well as the expenditure obligation of the states are described. So if you look at that, then we observe that there is a mismatch between the revenue raising capacity of the union government and expenditure obligation of the union government and state governments. That means union government has more revenue raising capacity. On the other hand, it has less expenditure obligation. But on the other hand, states have less revenue raising capacity, but it has more expenditure obligations. The reason could be that the state government basically is closer to the people, so it has to fulfill more demands of the people. But on the other hand, the union government, which is little far away from the people, basically has more revenue raising capacity and it has less expenditure obligation. So this mismatch between the revenue raising capacity and expenditure obligation of the union government and state government is known as the vertical fiscal imbalance. So then we should know the horizontal fiscal imbalance. Now, in horizontal fiscal imbalance, we discuss the mismatch in revenue raising capacity and expenditure obligation of the states. And we observe that some states have more revenue raising capacity than the others. The reason could be that some states have more organized sector like manufacturing sector or service sector, but on the other hand, other states have less organized sector. So the states that have more organized sector or a manufacturing base would be able to raise more revenue. But on the other hand, the states that are uh, primary in nature, that means the states which are more agrarian in nature would be able to mobilize less revenue. So that means some states would have more revenue raising capacity, but some other states would have less revenue raising capacity. But the Constitution of India, or as India is a democratic country and it is a welfare nation, the people have the right uh, to to enjoy at least basic minimum level of public goods. So when I say basic minimum level of public goods, it basically refers to safe drinking water, availability of availability of electricity, then education level, then we have health facilities, then roads, infrastructure, all these facilities should be available to all. Otherwise, what will happen? The people will move from one state to other. If they believe that uh, that some state is providing better public good than the other, people may start moving from one state to the other. So this will create extra pressure on some states, or at one point in a country there will be more pressure because some state government is able to provide more public goods. Of course, here we are assuming that the movement of the people is costless and there is no political barrier or there is no social barrier to it. So, if under that assumption, people may move from one part to the other. And as I told that as a welfare nation, every individual has the right to get basic minimum level of public good. That is why the constitution basically believes that every individual should get a minimum level of public goods, and there should not be much difference in the availability of public goods. And it is said that the equal level of public goods and equal level of taxation, taxation. So there is a horizontal fiscal imbalance also. That means some states have more revenue raising capacity, and so some other states should have less revenue raising capacity. So that say some states will be able to spend more, and some other states will not be spend more. So this will create a horizontal fiscal imbalance. And to correct both the vertical fiscal imbalance and horizontal fiscal imbalance, the Constitution has made a provision. Article 280 says that the President of India shall appoint a finance commission which will basically recommend the President of India how to distribute the resources between how to distribute between union and states of the net proceeds of the taxes which are to be divided them uh, under some rules of the constitution. And then it will also recommend how to provide grants in aid of the revenue of the states out of the consolidated fund and any other matter. So basically, there is a constitutional provision that the Finance Commission will be appointed by the President of India, and this Finance Commission will recommend the President of India how to transfer some resources from union to the states. Because as I told in the beginning, that union has more revenue raising capacity, and on the other hand, it has no, on the other hand, states have less revenue raising capacity, but they have more expenditure obligations. So constitution makers realize this, and they have made a provision that the constitution that the president will appoint the commission to transfer the resources from the union to the states. Now, the revenue raising capacity, the revenue raising powers of the state government are described in the seventh schedule of the constitution, that is in the state list. We had discussed that in the previous video, that the seventh schedule of the constitution talks about the union list, state list, and the concurrent list. Now, the state list of the seventh schedule basically describes the powers, basically the revenue raising capacity of the revenue raising powers of the state government. Now, the entries starting from 45 to 63 talks about the revenue raising capacity of the state government. Now, what are the powers or what are the taxes or revenues that can be collected by the state government? The first one is land revenue. Although land revenue generates very less amount of money for the state, but still it is a power with the state government, and it is, remember, it is a direct tax. Now, then second one is taxes on agricultural income. Although it is a very controversial issue, very few states are able to impose agricultural income tax, because we know that that it is a political issue. Many people would not support a tax on the farmers' income. But however, a few states are imposing agricultural income tax, and the net proceeds of agricultural income tax is very, very low. So this has been a very controversial topic, but still the constitution gives the power to the state to collect taxes from agricultural income, and that can be collected by the state government. Then we have duties in respect of succession to agricultural land. Then we have estate duty in respect of agricultural land. Then taxes on lands and buildings, taxes on mineral rights subject to any limitations imposed by the parliament by law relating to mineral development. So I should clarify this point 50, that in case of mineral rights, since the states are the owner of the land, they would get the revenue that is coming from the mineral, that is called as royalty. And but however, the royalty is determined by the union government. So in India, minerals are regulated by the union government, but since the ownership right of the land is with the state government, the revenue goes to the state government. And then comes duties of excise on the following goods manufactured or produced in the state, and countervailing duties at the same or lower rates. Basically, the duties, excise duties on alcohol, liquors for human consumption, then opium, then Indian hemp, and other narcotic drugs and narcotics, but not including medicinal or toilet preparations containing alcohol or any substance included in the subparagraph B of this entry. Now, if you recall, then when we discussed the powers of the union government, it was discussed that the union government collects the excise duty on the medicinal and toilet preparations. But when it comes to the alcohol, liquors, or opium, or all these things, the state government has the power to impose excise duty. Now, entry 52 talks about taxes on the entry of goods into a local area for consumption, use or sale therein, and then taxes on the consumption of sale of electricity, then taxes on the sales and purchase on other than newspaper subject to provisional entry to 92A of the list, and then Entry 55 talks about the taxes on the advertisements other than the advertisements published in the newspapers, then taxes on goods and passengers carried by road or inland waterways, and taxes on vehicles, whether mechanically propelled or not, suitable for use on roads, and article entry 58 talks about taxes on animals and boats, which is very rarely collected, and the tolls, and taxes on professions, trades, and culling and employments. So remember here, after the introduction of goods and services tax, many taxes have been subsumed under goods and service tax, but the constitution gives this power to the state government to collect these taxes. So remember, uh, in the seventh schedule, in the state list, entries starting from 45 to 63 basically enlist the revenue raising capacity of the states, or we can say the sources of revenue for the state government, or the taxes, both direct and indirect taxes that can be collected by the state government. Now, to understand the revenue raising capacity of the state government, I have taken the example of the Odisha state, but the viewers can take the example of any other state that they wish, and for that I would suggest they should visit the website of their state government, and they should visit the finance department and then the budget, and then they should look at the budget at a glance, which basically gives a summary sheet of the total revenue that they collect from the state government. Now, if you see this, I think we should discuss this first. So we can say, just like for the union government, receipts are of two types. One is revenue and capital, and the revenue receipts are of two types: tax revenue and non-tax revenue. And then taxes are of own revenue and share taxes. So I told you what is the share tax. And since there is a vertical fiscal imbalance, the union government transfers some of the resources to the states, and that is basically called as share taxes. And so whatever taxes are collected by the state, by the finance, by the union government, a part of it is shared among the states, that is called as share taxes. And then among the own taxes we have direct taxes and indirect taxes. Similarly, in the capital receipts we have debt capital and non-debt capital. Debt means basically borrowing, and non-debt capital is basically the disinvestment proceeds or recovery of loans. And among the non-tax revenue, we have own tax and grants in aid. So other than not a share in taxes, the money also flows from center to state through grants in aid. That means, for different schemes, union government provides money to the state governments. Nowadays, the union government also gives money to the panchayats directly for implementing different schemes. Similarly, the union government implements different centrally sponsored schemes. So that is also coming as the grants in aid. Now, if you look at the Odisha budget, then we have this is the this is the budget at a glance of Odisha. Now you see here we have revenue receipt, then we have capital receipts. Now within revenue receipt we have tax revenue, within which you have own tax revenue, and then we have share in the union taxes. Then we have non-tax revenue, within which you have grants in it. Now within capital receipts, we have recovery of loans, and then we have other receipt, which and then borrowings and other liabilities, and then within which wage and means advance. So this is a very summary sheet, but we are going to discuss in details what are the revenue receipts of the union government, what are the own revenue of the state, what are the own revenue of the state government, what are the transfer that is coming from the center to the states, and then what are the capital receipts, what are the non-tax revenues. All these things we are going to discuss in details. Now, coming to the state's own tax revenue, I told you that within revenue receipts, we have tax revenue, we have non-tax revenue. Within tax revenue, we have own tax revenue. Then we have transfer from the union. Now, within own tax revenue, we have the state's goods and service tax, and then we have sales tax, and then we have motor vehicle tax, and then we have land revenue. We have stamps and registration fees, taxes and duties on electricity. We have state excise and other taxes and duties. Remember here that why there are two differences, different tax, that is state GST and sales tax, because there are some commodities on which now the state wants to continue the sales tax. For example, the petroleum product. Now, petroleum product has not been covered under goods and service tax. That is why center is imposing a separate excise tax. Remember, the central excise tax is known as production tax. On the other hand, the state excise duty is known as the sales tax. So here on the petroleum product, union government imposes a production tax and state government imposes a sales tax. So that's it. We are observing we have goods and service tax as well as sales tax. Ideally, the sales tax basically should have been subsumed under the goods and services tax. So these are the major own tax revenue sources. You can see the highest revenue comes from the state's goods and service tax, and then we have the second one is we have sales tax, and then next one is you have taxes and duties on electricity, and then you have land revenue. Contributes very meager amount. Sorry, state excise contributes quite a sizable amount. That is basically alcohol products and all these things. So these are the sources own tax revenue. Now, coming to the state's own non-tax revenue, the state government basically collects different fines and fees, and those are basically the non-tax revenues. Now, we have what are the major own non-tax revenue? We have the interest receipt, because the state government also gives loan to its public sector undertakings. It also gives loan to the urban local bodies, and it can get some interest from that. Then we have dividend and profits. If it has public sector undertakings, it can get dividends. So that is second source of non-tax revenue of the state government. Now, for some states like Odisha, mining royalties is a major source of revenue. So for Odisha, we are getting about 12,500 crores. Basically, at least we are expecting that much to get. So within non-tax revenue, you see that the mining is contributing quite a huge amount. So you can imagine that Odisha's budget is 1,50,000 crore, out of which if Odisha is getting about 12,500 crores, then it is a big amount. And then we have the major and medium irrigation. Then we have other receipts. Basically, other receipts would include different fines and fees from different sectors. So these are the major own non-tax revenue of the state government. See, I'm not going into the numbers because this number would vary across states, but just for your understanding, like which sector is contributing how much to the non-tax revenue, then you can get a feel of all these things. Now, coming to so we discussed the own tax revenue, we discussed the own non-tax revenue, that becomes the own revenue of the state government. Now, other than that, the state government receives fiscal transfer from the union government through two ways. One is from the Finance Commission, and then other is from the different ministries. Now, so the first one is the share taxes. Now, in share taxes, say whatever taxes are imposed by the union government, from every tax, the state government gets a share, and that formula is basically decided by the Finance Commission. So I can give the example that the 15th Finance Commission has decided that if 100 rupees is collected, then out of that 41 rupees will be distributed among all the states. Now again, among the how to distribute that 41 rupees among the state, there is again a different formula based on the population, geographical area, forest cover, and so on. And based on that, every state gets a share out of it. So whatever goods and service tax are collected, a certain fraction will go to the states. Similarly, from the corporation tax, from the taxes on income, including wealth tax, then we have custom duties, then we have union excise duty and miscellaneous things. So all these taxes are shared among the states, and the formula is given by the Finance Commission. And then we have grants in aid. So this is a formula driven. The shared taxes is basically a formula driven one, and then other than that, we have a grants in aid from the center. Now, for grants in aid from the center, again, it comes from the Finance Commission as well as it comes from the non-finance commission agencies, like we have different ministries. Because now we do not have the planning commission. When there was a planning commission also used to give money under this grants in aid. Now the money in Grand Senate comes under the central sponsored schemes. Then you have central sector schemes, and then you have disaster response fund, and then transfer from the state. Now, in centrally, so you should know the difference. If it is central sector scheme, then the entire amount is spent by the union government. State only gets the money. But in case of central sponsored schemes, the center gives some amount of money, and the state also has to contribute some money. So, for example, in case of say MG and RGS, when the scheme started, 90% money come from the center, but the state had to give 10%. Similarly, under Sarva Shiksha Abhijan, initially it started with 90% from the union and 10% by the state, but now it has become 50-50, 50% contributed by the union and 50% contributed by the state government. So that is a centrally sponsored scheme. Now for disaster response fund also, the Finance Commission gives this formula, and then that money comes to the state, and then money also goes to the local government. So these are basically the grants in aid from the center to the state, and this amount is quite a big amount for every state, almost every state. Now, so these are basically the revenue receipts. Within revenue, we discuss the tax revenue, non-tax revenue. We have own tax, so we have own non-tax. Then the transfer from the union to the state. Within transfer, we have share taxes. Then we have grants in aid. Then we have capital receipts. Now, I told you in the beginning that within capital receipts, we have debt capital receipts, we have non-debt capital receipts. Now, within non-debt capital receipts, we have the recovery of loans and advances, and then we have the disinvestment proceeds. But say for this year, the state government, Odisha does not have any disinvestment proceeds, but recovery of loans and advances will come under the non-debt capital receipts. Now, under debt capital receipts, we have market borrowing, loans from financial institutions, loans from Government of India, and then provident account net. So the state government can borrow from Government of India, which amount is now very less. Earlier, before 11 Finance Commission, the state governments used to borrow quite a lot of money from the union government. But now union government is not giving much money to the state government. State governments will have to borrow from on their own from the market. So you can see the market borrowing is basically the highest component within the capital receipts. Similarly, the state government can also borrow money from the public provident fund, because the state government employees give provident fund, and that is basically going to the state government. So these are basically the capital receipts of the state government. And so this is all about the sources of receipts, or the receipts of the state government. Again, I repeat that it includes the revenue receipts and capital receipt. Within revenue, we have tax and we have non-tax revenue. Within tax, we have own revenue, we have shares taxes. Within non-tax revenue, we have own revenue and we have grants in it. And within own taxes, we have direct tax and indirect taxes. Within capital receipts, we have debt capital and non-debt capital receipts. So with this, we conclude the discussion on the receipts of the state government, and then I hope you like this video. If you like this video, I request you to stay in touch with me. So to get updates on my videos, Please subscribe my channel, and my channel is basically youtube.com/c/capital AMA then Amarendra Das Niger. So this is my YouTube channel. Please do subscribe, because in my next video I will be discussing more issues relating to the public finance and Indian economy, which will be useful for the students as well as for the people who are preparing for the competitive examinations. So thank you very much. Thank you for watching.